one thing I've observed from retail traders is how much emotion impacts them. And the idea that you've got to be right. In trading, it's the opposite. We don't always have to be right. We can be wrong often and still make money if you can hold on to those winning trades. And that's where you've got to find some way of removing the emotion. Cut the losses quickly, move on to the next trade. But when you're in a trade, hold on to the winning trade.
Sitting down today with Chris Weston from Pepperstone. We had a chat a while back about trading and flow in the market. Looking forward to talk about this again. Chris, welcome back on the podcast once again. And I look forward to see where this takes us.
Yeah, it's great to be here, Etienne. Our last one, it was a number of years ago now, but I think the same concepts are very true, if not reinforced by what's been going on now. So maybe we can sort of have a chat about that. But obviously, great to be back on the podcast, and great to be talking to your listeners and viewers.
Tell me what's been going on since we last spoke. I believe it was in 2019 or so. So tell me what's been going on since then.
Yeah, it's been, I think we've all got a few more grey hairs since that time. But, I think, obviously the markets, the themes and thematics going through markets have evolved. Obviously, you go into crypto and that's evolved a lot in terms of the participation and market structure. Yeah, we see a lot of flows around that at the moment. And, obviously we've seen change in regulation. We've seen ETFs becoming a more prevalent influence on the price action. Treasury companies who are holding and buying Bitcoin and Ethereum and other coins on their balance sheets become a bigger influence. And actually the volatility in the market has subsided because of the participation coming through. So I think that's an interesting one. It's still a major feature of the crypto scene, but obviously seen that going through. I mean, if you go into the equity market, we've seen an evolution of the flows taking place, and obviously zero DTE in 0 days to expiry has become a major driver of the intraday price action you've been seeing in USX single stock equities and the S&P and Nasdaq as well. So that's something that we've been sort of toying with is trying to get more of an idea about how that plays into it. The idea about volatility in itself, what is the level of realized volatility in the market and how that influences implied volatility in markets. Yeah, that has a big influence on things like how much capital is going into equity markets, because there's the volatility dynamic targeting funds are such a big player as well. Leveraged ETFs become a much greater and much bigger or more prevalent force, certainly at the end of the day. When you see the rebalancings taking place to bring the prices in line with net asset value, that's become a bigger feature now as well. So a lot of the stuff that we talked about in the last video in 2019 has actually evolved and become even more of a consideration now. So flows for me and things like options markets and the influence they're having, they have an influence on liquidity and liquidity conditions and what happens within price action within an intraday basis. And so, you still see a lot of people saying, why was the market doing this? Why did the dollar do this? Or why did the S&P do this? Why did Nvidia do that? And a lot of the time, it's these flows that take place, which I think are obviously so important. And, they've become even more important than where we were in 2019 because they're a major dominant part. And it sort of reinforces the idea that price action is really what we want to do, because it sort of aggregates all of these beliefs and behaviors into the price, which is ultimately what we trade.
How do you use flow to make money? Can you actually get good information on flow and act on it, or is it kind of hard to figure out?
It depends what market you're looking at. So if you go into the FX market, because it's mostly OTC, that can be a lot more complicated. I'll give you an example here because, you get a lot of the sell side sales and trading desks who sort of put out real time information to their buy side clients, pension funds, insurance companies, investment managers, hedge funds, et cetera, who are buying their research and have access to their flow data on things like the IB chats on Bloomberg and various, and you can get access to their portals and look at that as well. But I think if you were to get this data and you've got your sales and research and trading relationship manager sitting there going, oh yeah, by the way, Chris, we've got real money accounts, asset managers, insurance who are buying euro dollar right now, and leveraged accounts who are selling euro dollar. How do you make money out of that? Well, you've got conflicting forces, and you might not act on that because who's more dominant in this market? The asset managers who are slow moving and really start the trends and perpetuate the trends moving forward, or the leverage managers, hedge funds, etc., who move around, who represent more sort of the retail trading community because they're much more fast money. So again, how do you make money out of this information? It's very difficult to do so. So you really need to understand how that works. I mean, then you go into the crypto world. And what I love about the crypto world is you can go into these places like Glassnode and CoinGlass and all these places that offer really good, deep information, rich information about on-chain data. You can get liquidation maps where they're talking about a lot of the leveraged information around, if market goes up here, then we're going to see shorts being closed out. Market goes down, goes down here, longs are going to be cut out. Again, I think that's quite useful information, but there's so much of it, that you can look at that really you're trying to say, how do I actually look at what is actually useful information and what is signal and what is kind of noise in that situation. You go into equity markets and you're looking at things like, what's the gamma position from dealers? Are they short gamma? Are they long gamma? Because that's really interesting as well, because once you start understanding how market makers are positioned in terms of their gamma profile, whether if a market was to have a move, whether they're going to be looking to sell into strength, to hedge their delta, or look to buy weakness and therefore becomes mean reverting depending on the gamma profile, or whether you see this kind of situation where they hold a certain gamma exposure, and if the market goes up, they actually are buying the underlying as well, because the street have been long calls and they've been selling calls, and so if the market S&P futures go up, or S&P goes up, or Nvidia goes up, they're perpetuating the trend higher. So a lot of this information is quite useful, but what it does is it plays into our understanding of risk, and again, it comes down to price. So price is moving up. If we know dealers are effectively short gamma, the street has been buying calls, then you can see this really strong trend that pushes up. And then you understand where things like CTAs and commodity trading advisors are, and if they're not max long, you can see this. You can see this really strong trend developing in price, which obviously price is what we're looking at. So I think there's a lot of information that we can get out there for people who are new to that and who can get that information. Then the first thing you've got to understand is, how do I actually make money out of it? What's of use and what's not, and what's noise and what's actually signal, and how can it reinforce my idea about what price could do and what the probabilities about where price could go because of this information. So that takes some education, and that's some getting used to. But at the end of the day, if you look at what's driving markets, it is flow, it's sentiment. And when we look at all the people, all the different beasts and bots and everything that are out there, in an intraday position, you've got all these options flows that are taking place. You've got leveraged ETF rebalancing taking place. You've got volatility targeting funds going, your high frequency trading. It all just comes into, it's good to understand who you're competing against and who's moving money around and capital around. But I think what's important for us traders is that's all reflected in the price. And when you understand who's moving this around and why they're doing it, it makes us open our eyes to the idea about where, we don't actually necessarily always need to know the why behind why price is moving, because these flows could happen for any reason at all. And what it does is gives us an open-minded to be able to react to price much more efficiently. We don't necessarily need to go, this Federal Reserve person said this, or this data point's doing this. It's captured in these flows in price action. And that to me is the most important thing. It reinforces the idea that the price that what you see in any kind of bar within any kind of time frame, whether it's 1 minute, 5 minutes, an hour, daily charts, it just reinforces that this is all the flows just aggregated into that roadmap. It's all the beliefs, all the behaviors that are taking place. And that is the most important thing. That's what plays into our risk. That's where we look at the price action, the trends intraday that go into the market environment. And that really says to me, like, what are the probabilities? How is the collective in the market feeling about the current setup, the current volatility, the sentiment in the market? It aggregates it all into one. And that's what I'm trying to trade. I'm trying to trade the aggregation of all of these collective beliefs. It's not what I think. It's not what I think at all. I'm just a small fry in this massive pool of capital, but it's the price just encapsulates all of these beliefs, aggregates it. And what we're then trying to do is make a probabilistic outcome about where it may go. We've been seeing something like silver and gold having this ripping uptrend. We're saying to ourselves, given positioning, given these flows, given price action, is the probability that a higher probability skew that this is going to continue going up, go sideways, go down. And that's really what we're trying to do. But all of those beliefs are captured into price. And I think that's really powerful when you actually understand who's moving capital around and why these flows happen and what it means for price. It reinforces the idea for me that, yeah, the price action in the market is the only fundamental that you really need in the market. And it helps our risk management. It helps our what strategy you're going to employ. And I think that's really powerful.
If you are enjoying this interview so far, then I think you'll like this one over here. I've been working on this book for a long time called Prop Trading Secrets. It's finally out. You can get it in your favorite bookstore or on Amazon, Barnes & Noble, of course. And this book is really about interviewing traders who are successful in either trading for prop firms or managing their own private fund. We talk about their background, what makes them successful, the things they went through, struggles they had to go through to become good traders now, and a lot of the good wisdom that you might not necessarily hear about, but it's all into a condensed version over here. You can read through these stories, get inspired, of course, learn a lot about what they do, their strategy as well. And we summarize everything at the end where you have a whole chapter of summaries of what these traders have in common. So if you want to check it out, 14 traders in this book that myself and Kathy Lean interviewed. There's a lot of good wisdom in this. If you like these interviews on YouTube, I'm sure you like this one for sure. Go grab it. Like I said, it's on Amazon, Barnes & Noble, it's on Audible in audio version. All the other audiobook platforms will have it too, or your favorite bookstore. So check it out. If you did read it, let me know in the comment section below which one is your favorite chapter, and we'll get back to the interview. Since you mentioned flow is kind of also in the market price that you see on the chart, how does that differ from just technical analysis as people used to do it? Is it different? Do you need to go beyond just analyzing the charts technically, or is that enough to just make money?
Well, I think it comes down to your system, really, doesn't it? I mean, technical analysis for me is you're just trying to find repetition in behaviors. And if you can find repetition in behaviors, it's no different from, quant investing like Jim Simmons, for example. It would just be it was just looking for repetition in prices. And when he saw repetition that led to an objectively high statistical outcome, he would trade on those situations. And that's really what we're doing at a nutshell in technical analysis. Why do people look at head and shoulders? Why do people look at triangle patterns? Because really what you're doing then is you're looking for repetition. If you can back test and look at these and see how many of these over a certain time frame have a certain outcome, then you're going to trade if that outcome's high enough. And that's what we're doing is we're looking for repetition in chart patterns, in price action, in the way things react to certain data points, in the lead up to data points. Obviously, that's what people look at machine learning very much because you can crunch numbers very, very quickly and get those. But I think it comes down to your system, really. If you're running a momentum system, if you're running a breakout system, if you're running a mean reversion or trend following system, your system is your system. And really then what's most important is the market environment, the trading environment that's put in front of you. And, if silver and gold are ripping higher and you're trending, you're not necessarily going to trade mean reversion until you get that signal that things have got multiple stretchness. You're going to be looking maybe to trade a swing and buy into that pullback. For a continuation of the trend, but it really is, your system is your system. So you got to trade what the market's put in front of you in a certain instrument, and you go across markets, go across different instruments to find something that really fits that system. In my opinion, if you trade in mean reversion, you've got to find a market which fits a high probability of that happening. So again, it comes down twofold. What is your trading system? What is it trying to achieve? What markets does it like to do? What is the market environment that it operates best in? And then it comes down to the market environment. Is it a trending environment? Is it high volatility? Is it low liquidity? That's the most important thing. So, technical analysis is really looking at a set of behaviors and looking for an outcome, within that plays into your trading system.
You work with a lot of retail traders and also some pretty pro traders at Pepperstone. How do you see these people trade differently? Do they use the same tools, or do they have different things that they tend to follow?
Well, I think it comes down to, you've been doing this for a long time, and you teach on this, that I'm sure you talk about that. No one trader is the same. Everyone has their own. Trading is really in an idealistic way is a reflection of yourself. Unless you're sitting there in a prop trading desk with 5 other people who are given a system, and you're trading that one system at the same time, then really for the average person out there, then your trading needs to reflect you and your set of circumstances. I've got 3 kids, for example. I've got a day job where I'm looking at markets, and I'm very lucky because I can trade during the day while I'm doing my job. or at night once the kids go to bed. But if you're a plumber, for example, let's say you're a farmer out in the fields and you're looking after your cattle, fixing, doing mustering or something like that. Well, you're beholden to the hours that you can get in front of the screen. And therefore you've got to have a strategy that fits into your trading to the time available, for example. And that would be different for each person. So if you've got 2 hours a day to actively trade, well, you can either, scalp in that 2 hour period or trade very actively in that 2 hour period, or you can go to an automated trading strategy that can trade for you when you're out and about, and obviously hope that it, obviously the risk management, everything executes to get you in the trade and get you out of the trade as per that situation. But then it all comes down to what you're interested in. Whether if you're, a numbers person and you can back test stuff and you can optimize and you can do it properly, without curve fitting and all that sort of stuff, it comes down to your ability to code and all that sort of stuff. So I think, it comes to, in a nutshell, what I'm trying to say here is that each person that's out there has will trade as per their circumstances and their needs and wants and their risk objectives as well. So, we see people who, it might be just gut traders or what we call tactical traders. They're trading the news or where they feel things could go. We have people who are straight technical traders who just look at patterns. We have price action traders who go on naked charts and those factors. And then we go into more sophisticated people, who go into automated trading systems and, they can optimize it and do back testing correctly, or maybe even going to like long short strategies, tactical trades around relative value, for example. So I think, you get this whole sort of unique plethora of trading strategies and styles. But again, it comes down to the individual or individuals, and their set of circumstances and what they're trying to do, and whether they're doing this professionally or whether they're doing it as a sort of a secondary situation, and how that fits into their day job. So I think it's very difficult to say one size fits all, because trading is very unique to that individual.
Is automation, you think, the way forward now? Is it going to be a trend that everyone's going to want to automate their style eventually, or it's only for some people still?
There's two ways to look at it. First of all, I think having a rules-based system, whether that's automated or you just follow it in a kind of systemized, discretionary way, I think is very, very advantageous. I think the idea of being able to say to take trades based on on a rules-based, rigid, robust trading system, whether it's momentum, breakouts, or whatever you're doing, whatever that strategy is, I think is incredibly important to have. You look at something like silver at the moment, which has just gone parabolic, and I'm using this, and people might see this video in a year's time, but it's a great case study, and gold's a similar situation, and equities at the moment. We've just seen this relentless rise of higher highs and higher lows, and every pullback's been very minimal in that situation. Now, for me as a trader, you're sort of sitting there going, well, how do I get, as a momentum trader, I'm sitting there going, well, or even a trend trader, your win-loss rate isn't really a major consideration. You don't target a win-loss ratio. You're targeting, your distribution is effectively heavily skewed. So you can have lots of losing trades, but so you've got to hold on to those winning trades as much as you can. You take the loss very quickly, and you've got to extract and hold on and remove any kind of emotion that you get from holding a winning trade. And that's really, really important. So having a rules-based trading system keeps you in the trade and unemotional when you sit there going, this is already up 10%, but I haven't been given an exit signal, but I don't want to be wrong. The human race is told we're always got to be right. We're always got to be right. But you feel that I haven't been given an exit signal, whether that's price, just very simplistically closing below the 5-day EMA, or you have a moving average crossover or Keltner bands, or whatever you're going to use. Just keeping yourself in the trade is the most important thing in those situations. So when emotion rises, when you've seen the strong trend, you're making a lot of money on the trade, you look back in a couple of weeks, it's kept going, and having a rules-based system is really advantageous. Obviously, in that situation, you can automate that. But I think whether that's the future, I've been saying it's the future for 4 years, and I still think that you haven't necessarily seen the percentage of traders who are using automated trading systems rise substantially. But I do think one thing I've observed from retail traders is how much emotion impacts them, and the idea that you've got to be right. Whereas, Etienne, in trading is the opposite. We don't always have to be right. We can be wrong often and still make money if the winning trades if you can hold on to those winning trades. And that's where you've got to find some way of removing the emotion. Cut the losses quickly, move on to the next trade. But when you're in a trade, hold on to the winning trade. And, I was told a long time ago by someone who's, very influential in my trading that we're a manager of losing trades. Well, that's important. You've got to do something about those losing trades, because you can't stay a losing trader, because, if you let it run and it keeps kicking down because if you feel the market's going to come to you, well, that's a good way to blow up your account. But for me, I find it very, very, very easy to cut a loss. Whether I'm doing that automated or systematically, or just doing it from my own discretionary systems, I find it very easy to cut a loss. But it's the holding part of a winning trade that, I think people, just don't pay enough attention to. And that's really where you're going to be making money, because, as I say, use the silver, use the equity, the NASDAQ example, holding on to those winning trades is really important. So there are some really big benefits with removing any kind of emotion and letting a system trade on your behalf. I think that's a really fundamental part. Now, the problem with automated trading systems, in my opinion, if you're coding them up and back testing them yourself, is I think a lot of people just don't know how to do a proper back test. They're over optimized. They're looking for things that suit their mindset. For me, this is you go into MT4, you go into the MLQ4 supermarket, if you want to call it that, and you see those EAs where they're saying, this EA has to be worked on cable in the 1 hour chart. Well, that to me is just a complete optimization, because they're only saying this only works, and it works optimally on that one setting. For me, like a robust automated trading system works across multiple asset classes. It works, on different time frames, and that's what it's doing. So for me, when you're actually conducting a back test in your out of sample data, your in sample data, and then optimizing it so that you're not creating biases, and coming out, creating outcomes that say, wow, this has worked really well, so I'm going to play this one out. I think that's a really important part of being able to do a proper back test and then deploy the trading system in that world. And I think what's interesting now, if you go into a lot of what's happening in the AI scene, what we're seeing is the hedge funds are actually running massive data samples across, through their large language models. And what sort of thing's really interesting, Etienne, now is that what we're seeing is people are not trying to predict price. They're not trying to predict price, because that's a really good way to blow your account up in that world. What they're trying to do is they're using massive data samples to try and understand and predict the probability of a market regime the next day or the week ahead. And that's worked really well. So what we're trying to do is we're trying to understand what could be the market environment. So high volatility, higher range, whether we're going to see an intraday trending day, high-low trending day, those kind of situations. And when you can see a high probability, above 75%, for example, of a certain type of trading environment for the next day, well, then your trading strategy, if it's back tested and fits really well with that kind of market environment the next day, people will deploy more capital to that trading strategy. So what it's really down to is the trading strategy, how it works optimally in a trading environment. And if you can then use AI to do that, you can then your hedge funds will put more money on a strategy. So it's at the strategy level, more capital on that strategy, and take capital out of a strategy that is set to underperform in that market environment. And again, I think that's where automation can work really well. Once you've got that system, you can do all that sort of situation. So look, I mean, it's not for everyone, and you've got to do it correctly. And not over optimize, and that takes some sort of statistical knowledge. But if you can do it well, the major beneficiary that I found is that you're not taking trades when you don't need to. You're not revenge trading. You're not being induced into the market because higher or lower volatility, and you get out the trade not because you're forced to, because you go, I don't want to surrender the profits, but because the trading system does it. So that's really where I see the major advantages. Now, is there further growth? I think that there should be. But to get into that world, you buy the system and hope it works out for you. Or if you want to do it yourself, it does take a lot of time and a lot of research, but it can be obviously very, very beneficial if you get to that point.
I think you mentioned a good point, the fact that automation doesn't have to be about entries and exits all the time. It can be about other things, like you said, or trying to predict the accuracy of a specific market condition, or what's going to happen with the market context too. That's a good point.
Yeah, I mean, there's been some really good podcasts about this whole situation. But if you're a day trader, take a day trader for example, you're trading S&P, US 500 on Nasdaq or stocks intraday, and you close the position before you go home at the end of the day, and you obviously don't carry any risk over, and avoid the gapping bits and pieces. What you're doing is you're just looking at price, and you're saying, well, how's price trading in that day? Some people will go very basic. I don't know how many people use this day, but like the opening bar range and, how effects of that. People look VWAP strategies and anchored VWAP and all these kind of various factors. But really what you're doing is you've got your strategy and you're looking at those flows and how they affect price during the day. And you're open-minded to where the price can go, because it's, you've just got these big hitters that are doing stuff which doesn't necessarily make sense relative to the news that are coming through. But it's the trading environment that ultimately dictates that strategy and how it performs in the strategy. Because, you might have a higher range on the day. Obviously, you might have more price to play with. Higher, low, range expansion compression is interesting. You might have just a complete high to low trending day, and reverse. So, or you might have choppy, scatty price action that comes through. But that's what the market's giving you. And that's what we've got to try and make money out of. And that's what we've got to manage our risk around. So, the volatility in the market, liquidity in the market, how fast it's moving, how it's reacting. This is what we're trying to make money out of. And that's really what you're doing. A lot of people, obviously, if you take your time frame out, for people who are trading off the higher time frames, maybe swings, who are trading off 4-hour charts, daily charts, and looking at the big picture flows. Well, that's a whole different factor. But again, the market environment is still really important. So, how it's trending, where you want to put your stop loss relative to the move in the market, because obviously if there's bigger ranges, higher volatility, well, you need to put your stop loss further away. And that means you're taking more risk, which means you take your position size down accordingly. So how much notional you're risking, or how much of your account you want to risk on a trade, will be down to the market environment, how price is moving around. If it's very low volatility, low range, of course, we all know that, in that situation, you can run tighter stops. You obviously taking less risk on, you can increase the position size accordingly. And I think that's one of the things you see from a lot of really new traders is, if you go back to March, April of this year, 2025, we saw that massive volatility explosion, where markets just got absolutely smashed as Liberation Day hit, and then people couldn't price risk in the market. It was just people were concerned about funding issues coming through. And I think you obviously saw the tariffs come out 2.5, 3 times higher than what the market was anticipating. And you saw this huge explosion in wow, what does this mean? This is massive uncertainty in markets. And of course, that's what we do in markets. We're trying to price risk and certainty. And when that uncertainty increases, then the distribution in outcomes in markets increases. We get fatter tails. And, that's where you get massive volatility, lower liquidity in top of book, and system liquidity dries up. And that's where you get fast moving markets. So what you saw, going back to my point, was that in that situation, we were running wider stop losses, taking the position size down. And I think new people in the market didn't react, and they weren't reactive to that volatility and the range and how markets were trending, and then continue to trade similar sort of stop losses that they had before. And obviously that just means you get closed out of the position very, very quickly. So, we are a slave to volatility and range and price action. And I think that's really, really important. You've just got to react to the moves and volatility in market, and that sets your risk and how much you're taking on in the trade. I think that's really important.
Getting back to the market condition we see these days, we have pairs that are Forex pairs that are very kind of sideways, not doing much. We have pairs that are, or maybe commodities that are kind of trending really, really fast and not having any pullbacks. How do you make sense of all this? How do you kind of trade these kind of conditions in the market these days?
I run mean reversion and momentum strategies mostly, but I think momentum's worked really well this year. So you're finding stuff that's moving and breaking out, and that rate of change is picking up, and you're looking for price persistence, really. And that's worked well across markets. It's been tough in FX markets because there's just been, we saw quite a few trends developing in the dollar pairs, certainly in the first half of this year. And that's now we're seeing very whippy sort of sideways, choppy trade action in the dollar pairs this year, in the second half of this year. But the first half of this year was quite a good market environment in terms of that situation. But I think, obviously fundamentally now the dollar now, I think a lot of the hedging ratios of a lot of the hedging from insurance companies is done. And if we look at FX, central bank pricing now, I know we're expecting the Fed to cut rates again, both in October and December. And, we've sort of got the terminal pricing around 3%. But aside from that, the ECB are pretty much done. The Bank of England is saying they might do it again, but the rate cuts have been pushed out. The RBA are pretty much there and thereabouts. And we're coming to the end of the cycle. So that's suppressed a lot of the volatility in the FX markets. If you're going back to my idea of flows, when we're seeing a lot of people who have been selling calls and what's happened is there's dealers, therefore market makers who have bought the calls off the guys who are selling it. Their gamma profile means that typically it's a lot of mean reverting flows. So, market goes lower. They hedge their delta by buying, the underlying pair, and that sort of pushes back up and price rallies. And they have to hedge their delta to keep it in check by selling rallies. And that keeps things fairly suppressed. So we're just coming off a bout of one of the lowest levels of implied levels of FX volatility that we've seen for years. Again, rates volatility has collapsed. Bond volatility has collapsed. And I think that obviously plays into it. Obviously, I'd like to see that pick up again. I like a bit of volatility in this market. I'm not a carry trader. If you're trading carry, for example, going out and buying the Brazilian real and getting your 15% real rates, really what you want to see is choppy sideways trading markets with very, very low volatility. And then the hedge funds will pile into carry trades, and that worked really well. But I don't do that. I don't see that. But I was hoping for a bit more life. But for me, what's more important is I have my strategy enough. I'm looking for a market that, and it might not be in the FX market, that fills that. So TradingView is great for that. You've got this scanning product now, which you can code up in PineScript, and you can scan for markets that fit my criteria. And, then basically the mounting comes to Mohammed, and I don't have to go for a million different charts. I can just review. I can set a very basic level as to what sort of markets I'm looking for, whether, the short 3-day EMA is pulling away from the 8-day by a certain amount where price is in its 50-day range. Even things like where the 9-day RSI is, I'm looking for something that's high. I'm looking for it to move up, and obviously, something that maybe may have closed for the first time at least 2.5 standard deviations in above its Bollinger Band, or its Bollinger Bands are set at 2.5 standard deviations and prices closed above that. So there's a whole different thing. But using a TradingView scanning tool now, you can find a market that fits my strategy, which works optimally, and then I'll look for that. So it's really the market and how it's performing and how it's behaving that's more important, rather than just staying in FX markets and just trading one pair. I know a lot of people do still like to do that, and that's great, whatever works for you. But for me, it's more about I've got my strategy, and I'm looking for the market then that comes into that fits that criteria. So I trade multiple markets, and it's really just the market. Obviously, things like spreads come into this as well. If you start trading some of the agricultural or softs, they can be a bit more expensive from a spread perspective. But what you get in return for those more, I want to say, exotic products is you do get the ability for these prices to move and trend for quite good periods of time. So they do cost a bit more. But you do get a lot of the expectancy of those does actually increase, because you do get really sort of long lasting trends and persistent moves. So I think that's interesting. So I guess people who just trade cable because they love trading cable or euro dollar, great. But I'm more of I've got a wide universe of markets, and it's the strategy itself which is the most. And I'm finding a market which fits that optimally, and then obviously looking whether it's a good time to enter the market, where my risk is, how much my position size should be, and those are the factors.
Tell me where people can find you and connect with you after this podcast.
You can reach out to me on X if that's your thing, Chris Weston _PS. I think that's probably the best way. You can reach out to me there. You can go into LinkedIn, looked up for me. You can have, obviously, on the Pepperstone website, you can find all my details there as well and see some of the stuff we're doing. And we've got a YouTube channel as well. But always happy to interact with people, talk about markets and the balance of risk, or where the probability and the skew of risk sits in the moment. I'm sure a lot of what I've said will probably go over people's head, but I think it's really important to keep things simple. And what I've said is I mean, some of this stuff is complicated. It is. And, if if you've sort of lost on some of the stuff, I think it was what you can learn from this is I'd give a Bloomberg article who comes out and says our market was up on this, on XYZ headline. And you actually look at the move in the market, and that headline came out 30 minutes after the market actually moved. And 30 minutes in this market, in this regime and market structure nowadays, is an eternity. I mean, the high frequency algos are trading millions of times a second. And so it just doesn't make any sense. That it's just, you sit there and go, well, that's just lazy journalism, in the sense of, markets just don't wait half an hour to move. And so what you're trying to say here is the why things are moving around is when you understand the market participation, the market structure, it just brings us back to why price action and technical analysis is so important. It is just telling us a roadmap of the aggregation of all these beliefs that are taking place from these participants, which are really important. And a lot of people don't know they exist. And so that's why I think, bring it back to what price is telling you and what the collective are telling you. Don't think about what I think. I'm trying to understand what the collective are thinking in the market and where probability could go from there. So, it is a complicated situation, but it just reinforces the importance of price action and what it's actually telling us, and why fundamentally price action and technical analysis is really, in a lot of the cases, the only fundamental that you actually need.
Definitely. We'll put the link below you mentioned on the X as well as the pepperstone website. I appreciate your time here, Chris, for giving this advice and helping traders. Hopefully they can reach out to you and learn more from you in the future. I appreciate that.